All right, we'll proceed with our topic of selling the leaseback. So the first and most important point in an exam, if you just find the question of selling the leaseback, first of all, judge on whether there is a sale or not. The transfer of the asset may not constitute a sale. If it doesn't constitute a sale, as I just said, just treat it as a normal loan. So the lessee would have the financial liability and the lessor would have the financial assets, just like that. And then what if the transfer is a sale? The transfer is a sale, you have to deal with the following, right? Now, this just gives explanations, but let me just show you the simple way, the reality, and then we could proceed on how to measure. I don't want to deal with measurements right now. If something is, if the transaction is really a sale, that means we can say that, oh, someone who bought has actually leased out that asset. So there is a lease. So we have the issue of lease here. So I would have to debit right of use asset. Right now, I'm not explaining how to obtain the amounts, but you just know how to debit right of use asset, right? Okay. As usual, I would have to credit the lease what? The lease liability, just like that again. And then after this, you ask yourself, if you lease out something, first of all, someone who calls himself the lessee said sell. If you sell something, you expect to receive something. So they definitely would have received cash, right? So you can just write your cash there. And then you sold out something. If you sold out something, it actually means that you have to recognize that carrying amount of the asset. As you know, when you just sell an uncurrent asset, you determine gain also on disposal. So meaning that you have to recognize that carrying amount of the asset. So we come here and say credit that carrying amount of an asset. Carrying amount of an asset. I don't know at what amount it will be, but you just recognize that. So up to here, there are matters which are very easy to judge and others not. In an exam, you'll know the cash for which an item was sold before being leased again. We would actually know the carrying amount of the asset by that time. So our main concern here is on how to obtain the right of use asset and the lease liability. But actually, lease liability is also just easy. Just take the present value of future payments. Maybe how to obtain the right of use asset. But then after here, we would have the balancing figure. We usually call it balance. You can just actually can compute it, but just take it as a balancing figure. Now, as for the balancing figure, it depends. If it is on debit, it should be an expense. And if on credit, it should be what? It should be income, just like that. So initially, I have to understand this. And then, the sale the transaction can be a sale, but it cannot be at a fair value. If it's not at a fair value, it might be above fair value or below fair value. So you're also going to see that. So initially, I just need you to know this simple thing. First of all, copy principles of normal lease here, and then add something cash here and carrying amount here. And as for the rest, you're just going to adjust. So you need to know this very basic thing, right? Please, 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 just know this basic thing. Okay, now what we're going to do is how to obtain these figures now. Okay, so we proceed here. The seller must measure the right of use asset. We know that it is there, but how to measure it? As the proportion of the previous carrying amount that relates to the rights retained. Do you know what they meant by this? The seller is the person who initially had the asset in their ownership, in their possession. Right now, the seller has sold out the asset, but they have leased the asset back. As you know, if you sell the asset and they lease it back, that means you still retain some of the rights. So, to know the value of the rights you have still retained, you have to take them as the proportion of what you gave out. Let's say you sold an asset which had a carrying amount of 10 million, but maybe you have retained 40% of that 10 million. So that should be 40% of 10 million should be the right of use asset to be recognized initially, right? That's why they're just trying to explain. So don't face it as something awkward. No, that's why they're saying take it as a proportion of the previous carrying amount, proportion of the previous carrying amount that relates to the rights retained. Now, what matters is how do we obtain this proportion? This is the point here. How do we obtain this proportion? Remember, you sold an asset for a certain amount, but after selling it, you leased it back and incurred a certain liability. So you have to compare those two things. Okay? This means that the seller lessee will recognize a profit or loss based only on the rights transferred by the buyer lessor. As I told you, even if you just have a PPE debit, we say Daniels, we will them Daniels on disposal. This profit or loss based there, that's just nothing. It's just like we call gain, just call it gain on disposal to make matters simple to you. We get gain on disposal, we usually take sales proceeds minus the carrying amount. But we believe that we did not abandon all of our carrying amount. It's only some, the rights of which we have not retained. Okay? Yeah. So what should follow here will be how to determine that right of use asset. Not much big deal, right? I don't need to tire you so much on this. We just go direct to the question. What about the buyer lessor? The buyer lessor account for the asset purchased using the most applicable accounting standard. You know, you might have acquired PPE, you might have acquired maybe an investment property, it really depends. So the lease is accounted for by applying lesser accounting requirements, just like you normal. The buyer will be the lessor, so we use the lesser accounting requirements. If it's an operating lease, use a straight line method. If it's a finance lease, record lease receivable. As for the lessee, as usual, as for the lessee, it doesn't matter if it's an operating lease or finance lease, just debit right of use asset and the credit lease liability. Okay. Let's take a look at the text understanding and then we proceed further and it's complete. This is the last session. Let's be a bit patient and finish up. The question says, on 1st January 2021, Painting sells an item of machinery to college for its fair value of 3 million. And again, let me tell you, do you see this thing here, transaction not at fair value? If the transaction is a sale and at a fair value, that's what we do, as we saw above. If it's not at a fair value and there are some few additions which are just normal, so it was at a fair value, then the asset had a carrying amount of 1.2. So the asset had a carrying amount of what? 1.2 prior to the sale. So as we said, this carrying amount would have to be recognized, it would be removed, but actually we have retained some rights. We'll have to determine the gain also on disposal based on only on the amount that have been disposed. This sale represents the satisfaction of a performance obligation. That means the transaction is a sale, right? Because if it's not a sale, we do not recognize lease. Painting enters into a contract with college for the right to use the asset for the next 5 years. So, you know, Painting sold, but also they want to lease that asset back. So selling the lease back. Annual payments of $500,000 are due at the end of each year. So actually you can determine the lease liability here, right? 500,000 is year 1, year 2, year 3, year 4, year 5. We discount them and you'll get the lease liability, right? The interest rate implicit in the lease is 10%. The good thing is they have already given you the present value of annual lease payment is 1.9 million. Now do you see? At your own time, just try this. Try to determine the present value of this 500,000. Year 1, year 2, year 3, year 4, year 5. You would have to arrive at this figure here, right? But also, I would like to remind you one thing. You know, if it's 500, 500, 500, 500, we usually like to use that annuity table. I hope you did financial management. There's something called annuity table. Or you can just use the annuity formula. I just do not want to introduce it here right now. So the remaining useful life of the machine is much greater than the lease term. Oh, I think this is important when it comes to the lease account, because as for the lease, we do not care whether it's a finance lease or operating lease. But what does this signify? The remaining life of the machine is much greater than the lease term. It is usually an operating lease. because if it covers majority of the part of the asset, it could be the finance lease. So right now it should be an operating lease. Explain how the transaction will be accounted for on 1st January 2021, just at the very beginning of the list, by both painting and college. You see, painting now is a lessee and the college is a lessor. What would they have done? This is test to understanding number 9. So you just go there, test to understanding number 9 is here. Okay, we have painting. Now we have spoken a lot. Now just take a look at this and maybe I should simplify matters. Painting was the lessee. If you are the lessee, you have to do this right of use assets and lease liability. Now let me paste something here and show you that there are matters which you really need to know beforehand. Do you see this double entry which I wrote? I just gave you this double entry there before. If there is a lease, it's obvious that you need to know the right of use asset, which you need to compute. So just leave it alone first. The lease liability was actually given. It was 1.9 million, right? Just copy it. We have to recognize the carrying amount because you have sold. What was the carrying amount? The carrying amount was 1.2 million. So I need to recognize $1.2 million. And then you will receive the cash. At what amount did we sell? We sold the asset for $3 million. So I would say that the lessee received cash of $3 million. Now after this, now you can try to ask yourself for the rest. How do we do with the rest of the things? Right. I said that the balancing figure could be on debit or on credit side. So you find out that the major issue to deal with here is just how to determine the right of use asset. How do we obtain that right of use asset? We see that initially you had an asset of $1.2 million. All we need to know here is the proportion that is still retained. I sold it, I lost all of 1.2, but under the condition that I release it back, so I retain some rights. So by what amount do we always go here? As you just see, they multiplied by 1.9 over 3 million. All right, so you just multiply by the lease liability and you divide by the fair value of that sale, but at fair value, just like that, right? So this is what you usually need to know. Or maybe if you do not want to do that, you could have said something like this. I sold an asset of 1.2 million for how much? For 3 million. And in turn again, I got back that asset for what figure? And in turn, I got back that asset by incurring a liability of 1.9 million. So you can ask yourself here, what should be the corresponding figure? Just yourself something like this. If you do cross multiplication, this is what we're going to arrive at. 1.2 million of the possession of the asset that I had, which I valued at this amount. Right now, which possession can actually make the lessor being entitled to receive 1.9, which to me now as a lessee is a liability, right? Okay, so that's why you just do this and you obtain the right of use asset. So that's why here the word lease liability, we say that the right of use asset is we could have said that the right of use asset could have been obtained as 1.2 million times 1.9 over 3 million, which we actually got is 0.76 million. How do you see this? So this right of use asset comes here, 0.76 million. Boom, you are done. So all you need to know here is whether the balancing figure falls on debit or on credit. If you deal with credit side here, 1.9 plus 1.3, 3.1, here 3.76. So you find out that the credit side is in deficit. So I would have to credit something here and it should be a gain since it is on credit side. And this gain goes to the statement of profit or loss, just like that. So it should be 0.66 million, just like that. Do you see that? So just know the way how to approach these questions, and matters will be very, very easy for you. Just know how to obtain this right of use asset You can ask yourself this way. Initially, when something was in my possession, it had this value, but I sold it for 3 million. Right now, someone has sold it to me and requires me to pay 1.9 million. So what is the worth? So the first point here shows the worth. What I mean, the possession, initial worth, possession, I would say possession. It shows the possession, and here it shows the worth. When I had it, it had this figure in my books, but the worth of it seemed to be this way. Right now, when it was given to me, the one who gave me required this worth from me. This person to move from me. But at what amount should I record this? So this is what we're just going to ask ourselves, right? Yes, so we just have to ask ourselves this question. And if you cross multiply, you would get your result. So this is what I was trying to insist. And this is all about selling the leaseback. Now let's finish up with the last thing. It's nothing much. If you just get the concept here, it's nothing much. Maybe let's go to college. If you go to college, you know, college is the lesser. If college is the lesser, you have to base on whether it's a finance lease or operating lease. We saw that the useful life of the asset was very long compared to the lease term. So we say it's an operating lease because it doesn't meet the condition for a finance lease. So as you know, if for the lessor, if it's an operating lease, it's just normal. The lessor just recognizes the asset as his own. So the lessor bought the asset for 3 million. So actually credit cash for 3 million and debit that asset, that is the machine, for 3 million. And then you have to account for the lease under a straight line method, right? Yes. Account for it under straight line method. For this case, it wouldn't be difficult because we know that it was 500,000 all the way. So you just debit 500,000 in the income statement as an expense. This time, this is the lesser, so it's an income they receive. You have to debit cash by 500,000 and then credit income in the income statement. Just like that, and everything would be over. Now let's just take the last concept. This is just the last concept. Transactions not at fair value. You know, the transaction may not be at fair value. Now it really depends. That may be based on the right of, may affect the right of use asset or the lease liability. Let's say that the lease liability, instead of paying $500,000, maybe you are paying $400,000. Or maybe the asset is worth 30 million, but you are paying 32 million, or maybe 28 million. So it really depends on what you pay, or maybe what you sell at. Because you are selling something in return to pay something. So compare the pay, maybe you can just look at the payment you make or the amount for which you sell, right? Okay, so if not at fair value, what do? It's just the same as above, but we have to make some additional adjustments. If the sales proceeds or lease payment, sales proceed the amount for which you sell, or lease payments are not at fair value, IFRS 16 requires that. So it explains how to deal with below market terms and above market terms. Below market terms, for example, maybe when sales proceeds are less than the asset's fair value. You know, the asset has a fair value of 40 million, but you sell it for 30 million. We record this no more, but we have to make some adjustments, because what does that signify? These should be treated as prepayments of lease payments. Did you see this? You sell an asset for 30 million, but actually you should have received 40 million. We just treat it, since the guy would lease back the asset to you and you sold it for a lesser much amount, that means we presume that you are going to pay the same 40 million too, but you have already paid 10 million in advance. That's why you call it a prepayment, right? Because you're going to pay, you said that's it for 30 million, which while you should have sold for 40 million. But later you will lease it back and they will have to pay again those lease payments. So it presumes that you have already paid. That's why. Right. Now imagine another thing. Above market term, for example, the sales proceeds exceed the asset fair value. What do you do about that? The asset is worth 40 million, but you pay for 50 million. What does it mean? Remember, you will also need to pay them again. So Actually, the asset is worth 40 million. You have already paid 50 million. So it's like you have to pay 40 million. Why have you already paid 50? It's like you are financing them. You have paid them too much, right? I mean, you have sold to them. I'm just trying to distinguish it. You know, you could be speaking in the terms on the side of the lessor or the side of the lessee. Now it just depends on the side you speak of, right? For this case, if you say this way, sales proceeds exceed the asset fair value. You have sold an asset worth 40 million for 50 million. That means they have given you something already, right? So it's like they have financed you, they have given you much more than what you should have received. So you can just call it as an additional financing. So it just take a look on which side you're just trying to speak of. If you're just trying to take a look on what the lessee has done, the lessor has done to you, and you as the lessee, you just try and make a judgment. Okay, maybe let's just take a look at this one example, just single example, and everything would be over. Let's take a look at this Mosaic question. On 1st January 2021, Mosaic sells an item of machinery to Ceramic for 3 million. Mosaic sold this. Its fair value was 2.8 million. This was the fair value. The asset had a carrying amount of 1.2 million prior to the sale. Isn't it the same with above? All right. It's just the same question, but we are initially this 3 million was the fair value, but right now it was sold for 3 million, but the fair value is only 2.8 million, right? So it's like what? It's like the fair value is 2.8, but we have sold for much more than the fair value, right? Yeah. So it's like they have given us something extra. They have given us extra money. Then they say that this sale represents the satisfaction of performance obligation, so the transaction is a sale, no issue. Mosaic enters into a contract with Ceramic for the right to use the asset for the next 5 years to take back the asset. Payments are the same 500,000 as before, due at the end of each year. Interest rate is 10%, just as usual. And the present value of annual lease payments 1.9. This question is exactly the same as the previous one, except that the 3 million, which was the sale value, now is not at fair value. The fair value is only 2.8 million, right? Explaining of the transaction will be accounted for on 1st January 2021 by both Mosaic and Ceramic. Mosaic now sold and released it back, so Mosaic is the lessee, right? Okay, so this is what we would have to do. There is an excess sales proceeds here, right? Because we sold for 3 million, but the fair value was only 2.8 million. So there's an excess of 0.2 million. So it's like we have been financed. We sold something worth 2.8 million for 3 million. That means we have been given extra 0.2 million. So we call it an additional financing. Now, suppose the fair value was 2.8 and suppose the fair value was 3 million and they sold for 2.8. That means we would have paid much less, right? This is the fair value. Right now, the fair value is 2.8, but we paid 3, but we received 3 million, we received more, so we are financed. What if we received less? What if we received 2.8, but the fair value of 3, we received less? If we received less, actually that means that we would presume that we have already paid some of the lease liability, and so it should be a prepayment. But let's just go with this. Now, I wouldn't want to bore you much. Let's just go back to the normal principles here. First of all, as I told you, I would have to debit the right of use asset, just ignore its amount. I would have to credit lease liability, just like initially when you do lease accounting. Also, do not recognize the value. And then, as usual, I sold an item for cash of how much amount? For $3 million. Just write it down. I recognize that machine because I sold it and the machine was worth 1.2 million, recognize it. And then, as I told you, apart from this balancing figure here, something else will arise. We say that there was an additional financing. If there's an additional financing, this increases a financial liability. Now, do you see? We already have lease liability, but we find out that, oh, if there's an additional financing, that means there's an additional financial liability. In case maybe it was a prepayment, maybe we actually received less. If we received less, we should have said that we should have a prepayment. That prepayment of 0.2 would have come here on the debit side as a prepayment, or we could have incorporated it under the right of use asset under a simple line item. So it's just a matter of decision. When the transaction is not at fair value, either you add your financial liability, or you add here to the right of use asset, or you put here separately as a prepayment, right? Okay, now it should come to the point of knowing the values. If the financial liability is just the difference of that excess amount, 0.2 million. Now, the total liability was 1.9. So we find out that, oh, the total liability was 1.9 million, but it seems that some of that came from the financial liability. So 1.9 minus 0.2 million, we obtain 1.7. So you find out that, oh, total liability is 1.9, but part of it is a financial liability. Now we remain with the right of use asset, which is usually our concern. We said that to obtain the value of the right of use asset, you just go to the initial carrying amount and you'll find out the proportion of rights which you have retained. How do you obtain that proportion? We said that you take the lease liability, you divide by the sales value at the fair value, right? The lease liability initially looked like 1.9, but we know that it's 1.7, and the fair value of the sale was 2.8. So just place them here and obtain this 0.73. So you would have this figure here. And after this, we just compare debit and the credit. The lesser figure actually has to be provided with that suspense, and the suspense here is the balancing figure would be 0.63 million, and so everything would be over. So I suggest that when we deal with selling the leaseback, learn to know these first points: right of use asset, lease liability, and then you sell, you have cash, you also recognize the asset, and the rest will follow, right? So this is all I had to say in this situation. Now, maybe let's presume that our question, this question said that we sold for 3 million. The question said that we sold for 3 million, right? Again, the question said we sold for 3 million, but the fair value was 2.8 million. Now, maybe suppose we sold for 2.8 million, but the fair value of 3 million. That means you had sold for less amount. So that 0.2 wouldn't have been a financial liability. It would have been a prepayment, and it could really have been come to be added on the right of use asset. So I could compute the right of use asset, but then I could have come and add 0.2, that 0.2 figure here. I hope you got me about that. And then here we proceed as usual. The right of use, we proceed as usual, lease liability, which would now be 1.9 over fair value of the sale, which would now be 3 million, and then we multiply as normal. So I just believe that you have got that. And this is how we deal with these matters, right? If for ceramic is nothing much, when we deal with ceramic now we post the following, because ceramic just bought an asset, so ceramic would have a machine of 2.8 million, right? Ceramic would then have the asset of 2.8 million before, and then because actually ceramic received 3 million, right? Ceramic gave out 3 million. Ceramic paid for 3 million, yeah, no issue, paid for 3 million. But in turn, since that guy and actually incurred a financial liability of 0.2 million, then ceramic also obtained the financial asset for 0.2 million. So this balancing figure would obviously have come to the machine of ceramic, which is 2.8 million. So this is what would just be the situation, and we'll have to proceed that. So I just believe that you can go through this and get something. And then there's usually those questions, they are called the diploma in IFRS, but also even in SBR themselves, you can find a lot of questions like this. So we need to see the challenges, right? Okay, that's all about this standard.